In the previous lesson, we talked about waves. I showed you and spoke about how waves are fractal in nature. And also towards the end, I touched on how the nature of waves can give you clues as to where price is going next. That's what we're going to discuss now through the lens of a trend. So by purely looking at the candlesticks alone, you can deduce whether we're in a trend or in a range. You do that through impulses and corrections. Now, to clear up any misconceptions at the beginning, there are certain words that we use, and you've probably heard them or heard them used wrong in the past. Impulse does not mean pump. It doesn't mean up only. Impulse is how the price moves. You can impulse up, you can also impulse down. And especially this word, correction. A correction is not only a pull back in price, a correction can be a bounce. Price can go up or down in a correction. And trends move along the path of least resistance. And by resistance, again, resistance does not have to be overhead. It does not mean above you where price starts to slow down. Resistance can be to the downside as well. The word resistance simply means resistance to price moving continued direction. So on the schematic, it'll start to make a lot more sense to you. Uptrends are a series of impulses higher with corrections in between. The nature of it is you move up with very little resistance, the key there, path of least resistance, and on the way down you encounter resistance, meaning it doesn't just drop straight down, it drops in waves. Impulse again, path of least resistance, that's telling you the trend continues. Drop with resistance in a corrective manner, that's telling you trend will continue, most likely. Impulse correction, impulse correction. On the downside, exact same thing, just flipped around. Impulse down through the path of least resistance, and then we correct with a bounce that meets resistance. The bounce is struggling because the higher time frame trend is down. Okay? You have three types: uptrend, downtrend, and range. We'll touch on range in the next lesson. So now we go through uptrend and downtrend. And then the most basic and simple, but it's easy to forget, the nature of an uptrend is higher highs, progressively higher highs, and higher lows. And that is why drawing channels is so useful as a visual aid. A channel is not meant to be predictive of price. And for anyone who doesn't know, a channel are just these two lines to show the path of price. A channel will help you because if the channel is sloping upwards, it's an uptrend. If it's sloping downwards, it's a downtrend. If it's going sideways, it's a range. Sounds simplistic, but the simple stuff is what most people forget when it comes to live trading. So really remember that. Ingrain that in your head. Now, a very, very important thing with trend trading is you need to know what time frame you trade on and where you participate in the move. Let's go back to an example from previous lesson. We have uptrends here, 3 waves up, impulse correction, impulse correction, impulse correction. The white line is a daily chart, and we're going from point A to point B. The green line is a 4-hour chart and shows a series of waves within that. So for you, you need to decide which trader you are. Are you the guy who wants to buy A and sell at B? If so, you will broadly ignore all this noise in the middle. When the white line comes up here and starts to pull back, you don't panic and sell. You wait for confirmation of trend continuation or a reversal. Or if you're that'd be multi-week hold, most likely. Or if you're a lower time frame swing trader, you might want to trade over a few days or a couple of weeks. You'll take something like this on the green, where you catch parts of the move up and parts of the move down. So you catch both the impulses and some of the corrections, depending on how you trade. Looking at that on a live chart, let's say we have point A and point B. Point A, remember the position trader would enter here and let's say he exits here for argument's sake. We rally up with a strong impulse. Notice, no pullbacks. What does that mean? Path of least resistance was up. Okay. Then what happens? It meets a little bit of resistance and it corrects. Notice what I say, corrects, comes down, but bounces, comes down, but bounces, comes down. So on the high time frame, there was very little resistance on the way up. Then on the way down, it corrected in a 3-leg fashion. Down, up, down, up, down. Then strong impulse again, and then it starts to slow, and we're waiting for the same thing. Down, up, down, which would indicate a continuation most likely. Or if you were then at this point to see a strong move down, what would you be looking at? You'd be looking at the inverse. If there was a strong move down, you'd be then looking for corrective bounce, and that could potentially be telling you that we're in now a downtrend. So as a trader, you can get in a point A and out of point B. That's around 3 months. So I said, position traders are multi-month holders. But let's say you want to be more active. You want to be trading on lower time frames, let's say within this zone. So you go to the 4-hour, and you're trading as a swing trader. And what does the swing trader do? Well, the swing trader is looking to catch moves over a couple of weeks. This is 16 days. Perfect. What does he look for? Impulse down, corrective bounce. impulse down, corrective bounce, impulse down. So there's three, possibly four, but I would say three really good opportunities within this for the swing trader to catch some nice shorts. If that's your game, you build your system around that and you trade those type of moves. It all comes down to personal preference, what your character's like, how you are with analyzing data, taking it on. That will all be gotten into in much more detail in future lessons. But what you want to see and understand is the nature of how price moves. Note that on the low time frame, the 4-hour, even though we're in a higher time frame uptrend, it still respects trend trading when pulling back. Impulse correction, impulse correction. Then it goes back to the higher time frame character, which is impulse correction, impulse. And so that will show you and give you an insight into how trends move. To summarize it and look back, save the schematic, look at it frequently, and understand the direction of impulse is the direction of the trend. The correction should find resistance, and it should follow path of least resistance in some form of channel. That is trend trading in a nutshell. In future lessons, you'll get into much more depth about how to enter those trades, how to manage your risk, how to exit them. But this is what you need to know to become a trend trader from the basics. Now let's get into the next lesson and talk about how the nature of price action changes in a range.